Will China experience long-term economic stagnation like Japan did? This question gained widespread attention since the China-US trade war started in 2018, as Japan was the previous target of a US trade war, leading to its lost decades. Over the past 5 years, China's economy suffered multiple blows. 3 years of the pandemic, a plummeting birth rate, record-high youth unemployment, and a housing market crisis. These symptoms bear a striking resemblance to Japan in the early 90s. Will history simply repeat itself, or will there be an unexpected turn of events? Discussions on Japan's economic stagnation often link it to the Plaza Accord, signed in 1985 by Japan and 4 other countries, led by the United States. The accord aimed to depreciate the dollar against major currencies to address the substantial trade deficit faced by the United States.
The United States was facing a real prairie fire of protectionism. There was a lot of protectionist sentiment in the Congress. Legislation was being discussed, if not introduced, and it was our view that something had to be done about that.
After the Plaza Accord, Japan faced export pressures due to currency appreciation.
The dollar had been dropping, and now it dropped faster, down a record 4.29% the day after the Plaza, down almost 55% a year later against the yen.
To counter this, the Japanese government implemented loose monetary policies and aggressive fiscal measures to stimulate domestic demand. However, these actions inadvertently fueled a frenzied real estate bubble, ultimately resulting in an economic collapse. But why did Japan's stagnation last for 20, even 30 years? Recent theories, particularly from economist Richard Koo, have gained traction. He studied Japan's prolonged stagnation and in 1997 proposed the concept of a balance sheet recession. After the bubble burst, Japan entered an era of negative equity where no one took loans. Companies prioritized repaying debts over expansion, seeking to minimize debt rather than maximize profit. As a result, no matter how much the government lowered interest rates or issued more currency, companies borrowed only to repay debts, not to invest. Eventually, Japan even lowered interest rates to negative, but it still couldn't revive the economy, leading to the rare phenomenon of monetary policy failure. Ko summarized this as the disappearance of borrowers, the root cause of Japan's prolonged stagnation.
We in Japan went through all of it. Every one of the things that were put in place, we had to do it 5, 10 years ago, or sometimes 15 years ago.
China seems to be experiencing a disappearance of borrowers. For instance, since 2016, Chinese companies have significantly reduced their borrowing, almost dropping to zero by 2019 and 2020. Additionally, starting in 2023, many Chinese borrowers rushed to banks to repay mortgages early, prompting banks to set thresholds. Some believe that the balance sheet recession is just a symptom, with Japan's fundamental problem being a vicious cycle after reaching a population peak: negative population growth, excess capital, sluggish investment, declining wages, rising unemployment, and worsening capital surplus, forming a loop. Following this reasoning, China and Japan's situations also have similarities. Japan was the first East Asian country to face low birth rate plus aging, and China is echoing this 30 years later. In 2020, China's population age structure resembled Japan's around 1990, and due to the one-child policy, China's fertility rate declined faster than Japan's. From 1980 to 2020, Japan's total fertility rate dropped from 1.75 to 1.26. During the same period, China's dropped from 2.75 to 1.18. 2022 marked a significant year in China's population structure change. That year, China's population decreased by 850,000, the first decline since the early 1960s Great Famine. In just a few years, China's policies shifted from restricting births to lifting restrictions, then to encouraging births. The low birth rate plus aging issue mirrors the social problems accompanying Japan's economic stagnation. The collapse of the real estate bubble is another undeniable similarity. From late 1985 to early 1990, in just over 4 years, Japan's urban land prices surged by 200%. By 1990, Tokyo's land prices alone equaled those of the entire US. When house prices peaked and then plummeted, real estate companies went bankrupt. Banks collapsed due to skyrocketing bad loan rates, and ordinary citizens' homes plunged into negative equity overnight. China experienced 20 years of rapid growth, creating real estate giants like Evergrande. However, after policy tightening, it collapsed, leaving a $300 billion debt and millions of unfinished homes nationwide. And with 70% of Chinese household wealth tied up in real estate, a big slowdown in the sector is trickling through to other parts of the economy. People who have traveled to Japan might wonder, if Japan experienced lost decades, why does it appear materially abundant and culturally prosperous? The Japanese seem to be living well. This is because when Japan entered stagnation in the 90s, its development level was already considerable, but it then entered a period of extremely low growth. In 1995, the US's per capita GDP was approximately 28,700, while Japan's was around 44,200, 1.5 times that of the US. However, after 28 years, Japan's per capita GDP has fallen below $40,000, while the US's has surged past $65,000. From an economic perspective, China is unlikely to become the next Japan. The situation could be worse, wrote Nobel laureate Paul Krugman.
China is in much worse shape. I mean, at fundamental sense, China has a whole economic model that is not sustainable. It has vastly inadequate domestic spending, vastly inadequate consumer demand, has run out of sufficient investment opportunities to keep the economy rolling.
China shares similarities with Japan 30 years ago, such as reduced consumer demand and reliance on a real estate bubble to support the economy. The difference is that China's productivity lags behind Japan's back then. When Japan's economy stagnated, its per capita GDP was over $40,000. China's current per capita GDP is just over $10,000. Chinese citizens won't be satisfied with this income level, and discontent could translate into significant political pressure.